I want to go over with you what is likely a key pivotal moment in the market right now. As of yesterday, February 12th, the S&P 500 closed with a bearish pin bar on a major trendline resistance going back to February of last year. You can see that the trend started to form down here, and it's been tested multiple times up until this potential swing high. As you can see, the stock market has been pretty much straight up since the last swing low, with very few corrections and pullbacks. Now, as we know, the market doesn't go up in a straight line, and you can see that every push up is followed by a correction. Push up, correction, big push up, and now we can assume that sometime in the near future, we're probably going to have a correction. So there's a few other really important pieces of context that goes along with this thesis that I want to go over with you. First is going to be the RSI. So back in December, you can see that RSI peaked out right here when price was roughly right here. And ever since then, the RSI has been bleeding off, and price has continued to push and make new all-time highs. So the RSI is basically a gauge of the strength of the market, and when you have the RSI bleeding off with price still climbing up and making new all-time highs, we call this an RSI divergence, and it can be a good indicator that sometime in the near future, price is likely to reverse. Another thing we can look at is the stochastics, which is a little bit shorter term, but it recently just reversed from an oversold region. Another thing I want to point out is volume, which I think is arguably the most important thing to pay attention to when trading the market. As you can see, volume kind of peaked right around this area in December. If we line that up with the market, that puts us at about right here. And ever since then, if we drew a trend line, it would probably go something about like that, but price has continued to push up and make new all-time highs. So right there we have another major divergence, which is very important. So another piece of context that I want to go over that doesn't directly relate to the chart of the S&P 500 but is very important is the VIX, which is the volatility index. And if we zoom in, you can see that since December, VIX has started to create an upward trend line, and every time it gets back down to this trend line, it bounces 3 times, 4 times, 5 times. So with the S&P 500 being at a key technical price point on that trend line resistance, with the RSI divergence, the volume divergence, and now the fact that VIX is being supported on this trend line, you can start to see that a lot of pieces to the puzzle are starting to align here. Some other factors to consider that err more on the fundamental side are the fact that the market has continued to push up, even though Jerome Powell at the FOMC meeting pretty much squashed any chance of getting a March rate cut and didn't guarantee that we were going to get one at the meeting after March either. And after the hot CPI print this morning, you can see that markets are finally starting to come to reality, as the S&P 500 was down over 2% at one point today. So I do want to go over some potential trade setups in case this is something you're interested in, and some trades that I actually already entered on this. So as far as the VIX, on February 9th, I entered a starter position, which would be this candle, with just some straight long calls. And if you're not familiar with the VIX, it is directly correlated to the puts on the S&P 500. So if the VIX goes up, the S&P 500 is going to go down. So then on February 12th, which would be this candle, we seen price get supported by this trend line and close up with a bullish markup bar. And I doubled my initial position on VIX with some more long calls. Then on today, February 13th, when VIX shot up over 20%, I closed them long calls somewhere in here for a nice profit. Now I may look to re-enter this trade if VIX can come back down and get supported on one of these areas of value, but for now I'm not going to chase it up at these highs. Now going back to the S&P 500, you can see the bearish pin bar close on that trendline resistance yesterday. And then today, this morning, we had CPI, which resulted in a large gap down, and price found support on this 20 EMA. So I didn't actually enter a trade on SPY itself, but I did enter a small starter position on QQQ. And the reason I chose QQQ is it usually has a higher beta. So if the SPY is down 1%, usually you can expect the Qs to be down a little bit more. It's not always that way, but more than likely it is. So let's just say this is something you're interested in and you want to short the SPY in the short term. And you're looking at the chart and you're thinking, it already went down almost 1.5%. where do I enter this trade? So I'll go over some potential areas that I'm going to look to increase my short position on the overall market. So usually after a big move down like this, a tool that I like to use to give me another area of support or resistance is the Fibonacci's. So if we choose them here, I'm going to start it at the peak of the CPI, and I'm going to take it all the way down to the bottom of today's price action. And the only line that I'm really concerned with right here is this 50% line. So I'm then going to take a normal trend line and I'm just going to draw right over that 50% line. And then I'm going to go ahead and delete the Fibonacci's. So if I left click on this and edit properties, I'm going to name it 50% CPI. Show name on the right, and I want to change the color here. So after a large impulsive move like that, not always but often, price will tend to come back up and test the 50% retracement of the move. So this could be a potential area if we see price come back up into and look like it's going to reject, then this would be another area I would look to add to my position. So another potential area that you could look to add to a position would be the supply zone created from the CPI sell-off. So if we grab a rectangle, and I'm just going to leave it on the 1 hour chart, there might be a better supply zone here, like maybe a 2 hour or 4 hour, but this is still going to get us in the general area. And I'm just going to bring this up to the top of this pre-market high and probably draw it somewhere about right there. So now we have a supply zone drawn, and typically when price retraces back up, especially the first time, it tends to reject back out of these supply zones. And that is because this impulsive move out of this area of consolidation typically leaves back old sell orders from big institutions or whales. And when price gets back into it, you can expect it to reverse. And this doesn't always work, but I find that it does more than it doesn't. So if this is a move you're looking to take, there's a bunch of different ways that you could go about it. You could just buy straight puts on the SPY or the Qs. You could actually short the market if your broker allows you to short. You could use futures. But I'll just go over with you what I'm looking to do if price comes back into one of these key levels. And also just keep in mind that it is currently a counter trend trade because the SPY is still in a very strong uptrend, and there's no guarantees in the stock market, only probabilities. And it could very well find support on the 20 EMA and reverse back up and continue making all-time highs. It's just right now there's a bunch of different pieces of context that are coming together that give me enough confidence to enter this trade. So I'll go over quickly how I think I want to structure this trade. I do have to get ready to leave for vacation shortly, so I won't be able to go in super depth and break down this trade and all the aspects of it. But I think it'll be enough to get you by. So if we go over to the trade tab, and I'm going to scroll down to June, which is 129 days out. When we get back to the charts, I'll show you why I chose this. If you're looking to use options for this, you can choose whatever DTE you want to use. I chose this for various reasons. It just gives me time for this trade to play out. It doesn't mean I'm going to hold it for 129 days or even close to that. We'll just have to see what price action does. So whenever I go to enter this trade, when I do enter it, I'm going to choose to buy a put somewhere around right at the money. So let's just say we choose the 495 put. Now, the nice thing about Thinkorswim is right up here at the top, you can see this 40 number. That is the standard deviation for the time frame chosen. So just going off market statistics, the S&P 500 can be expected to move 40 points in 129 days. So for this strategy, I want to use a bear put spread, and I'm going to show you why. If I were to just buy this straight put, it would cost me $1,342. But we know that price most likely isn't going to drop way down, especially not to zero. So why wouldn't we want to sell a put at a lower strike price to help finance the cost of this bought put? So I'm going to go down, and the put that I'm looking to sell, I think is going to be this 460 put. So we hold in the control key and click sell. And now you can see we created a vertical spread, and the cost to enter this trade just dropped down to $787. So doing this does cap my max profit of the trade, and if price were to go down below 460 on the SPY, I won't make any more money. But I'm not expecting price to go down much further than that if it even gets down to 460 at all. So if we right click the trade down here, I'm going to hit Analyze Trade. I'm going to make sure I have no other trades selected. So this gives me the profit and loss chart of that trade. And I just like to go over it and look at different price points and see what my P&L is going to be. So we can see that the max profit of this trade with one contract is going to be 2,713 and the max loss is 787. So right off the bat, I can see that it's a very good risk to reward. So how I came up with that trade setup is looking back at the chart. This last pullback on the SPY lasted about 3 months. And then you can see with this red line, all I did was I took this 200 moving average and just estimated where it would be if you extended it straight out. And right here we also have the previous swing high that coincides with this trend line as well. So now if we could just imagine price coming down and correcting, somewhere in this area is where I would find price to be supported if it even gets down to there. Not only do you have the 200 MA, but you also have the previous swing high. So when I chose the June contracts, which puts me somewhere out in here, I had a few things in mind. Not only do I expect this to take time to play out, but when I have a debit trade and theta is working against me, I will close the trade usually about a month before expiration. So that would put me somewhere around at least right in this area. And that is because theta decay ramps up the highest in the last 30 days with options. Now we do have that sold put to hedge against that a little bit, but the trade still is long theta. And theta decay, if price doesn't go anywhere, will keep eating away at the trade day after day. Let me know down in the comments what you guys think. Is the S&P 500 due for a correction, or will it bounce off the 20 EMA and just keep making new all-time highs? Whatever happens, good luck trading.